Fiquei por 2024.
Entendi.
Fica uma vez sem pessoa. Todos na verdade, os deuses, a sua piscadinha.
do it. Hello, hi everyone. Yes, so I can see we actually have a quorum, and it will be very important to just kick off. Just maybe we can give a minute or two for those that are still joining us right away. Okay, so I think we can start. So hello everyone once again. Let me take this opportunity to first to thank all of you and to welcome you for especially those of you who were able to register. Of course, for you to have been here, you must have registered, and indeed you've created time to join us this morning. So this is a conversation about how the new tax changes affect your business. My name is Frederick Okendo, and I'll have the privilege of being the moderator today. I work at KKCO East Africa LLP, where we provide a wide range of services, some of which include audit, tax, outsourced accounting, professional human resource, company secretarial, and general business advisory services, among many others. And so in relation to what we are currently on this morning, we are living in a very dynamic world where things keep changing every single day. And so if you're not keeping tabs with the constant changes, it is possible to be left behind and possibly pay a much higher cost on the basis of ignorance, especially matters related to tax. The act was assented to by the president on 21st June and was gazetted on 23rd June 2022. The amendments are actually effective from 1st July this month that we are in, 2022, while others will be effective from 1st January 2023. And more on this shall be explained in detail by our team, who are standby to give us in very palatable terms. As usual, allow me to put our house in order. Use your hand, the raise your hand button, which is somewhere around at the bottom of the screen. And especially if you have a burning concern or a question. We shall also have a 10 to 15 minutes question and answer session at the end of the presentation. I kindly request that. Nimrod, you can hear me? Oh, let me just mute this. Gentlemen that are probably talking. All right, so we shall have a 10 to 15 minutes question and answer session at the end of the presentation. I am kindly requesting all of us that you probably write somewhere your burning question so that you can easily refer to it with ease when that time comes. I will ensure that you get a chance to ask and you'll be responded to appropriately. You can also type your questions using the chat area or the Q&A button. Of course, that is also at the bottom of the screen. Please note that we will share with you the notes as soon as possible, and that is especially when the webinar is over. Without any further ado, allow me to introduce our panelists today. We have CPA Nimrod Kurgat and CPA Tabitha Njogu. A brief profile of our panelists. Nimrod is a partner at KKC East Africa, in charge of audit and tax. He is a member of Information Systems Audit and Control Association, that is ISACA, and also a member in good standing with ISPAC. He has over 19 years of experience in providing full range of business advisory, audit assurance, risk management, and tax services, of course, in different sectors and industries across globally. I mean, I would say within the country, but also across the borders. So he is here to speak to us as well regarding tax, which he is also a representative in several clients. He represents several clients in tax tribunals. But we also have CPA Tabitha Njogu, who is a tax team leader at KKCU East Africa LLP, also a member in good standing with ISPAC, and also one who has gone through the KESRA. KESRA is Kenya School of Revenue Administration. I'm pretty sure that it's something that many of us are very familiar with. And so this team are here to help us understand how the recent tax changes affect our business in one way or another. Whether you have a business or an entrepreneur, or you're employed, or just an individual, you're just passing by, certainly tax as a way of affecting every single one of us. I think there's one American president who said that the only two things that are certain is death and taxes. And so welcome, team Tabitha Njogu. We can kick it up from there. Yes, welcome. Karibu sana.
Yeah, thank you very much, Fred, for the introduction. I think we are going to begin. Please allow me to share my screen. Yes, as Fred has mentioned, our discussion today will be about how the Finance Act of 2022 affects our business. And we're also going to discuss a few issues around the emerging trends. So to begin with, we're going to discuss the changes around corporate tax from the Finance Act of 2022. The first change being the change in definition of the word fair market value, where the Act has now removed any ambiguity in the terms of fair market value. Fair market value will now mean the market price available in an open and unrestricted market where independent parties that are not compelled to transact are trading. And it has to be expressed in money or monetary worth. There are also changes around realized foreign exchange loss, which has been aligned with the thin capitalization rules that were introduced by the Finance Act of 2021. So there's a restriction on the deduction of foreign exchange loss by companies that foreign exchange losses, realized foreign exchange losses should not exceed 30% of earnings before interest, tax, depreciation, and amortization. This is in line with the changes of the thin capitalization rules of the Finance Act of 2021, where gross interest payable or paid to third parties was not supposed to exceed 30% of earnings before interest and tax for it to be an allowable deduction. So, however, this amendment retains the word deferral, and therefore, as long as the ratio is met, then the losses can be deferred to future periods. So the implication for this is that foreign exchange losses will now be deductible as long as they do not exceed 30%, or they do not in any way result in duplication of amounts accrued in prior years. We also have an expansion of the list of entities that could be guided by the thin capitalization rules. Initially, the only entities that were exempt from these thin capitalization rules were the banks that were licensed under the Banking Act, and micro and small enterprises that are licensed under the Microfinance Act. However, this has been expanded to include microfinance institutions that are licensed under the Microfinance Act of 2006, and entities licensed under the Hire Purchase Act, non-deposit taking institutions involved in lending, companies involved in the manufacture of human vaccines, as well as companies involved in whose cumulative investment exceeds 5 billion, and the investment is outside Nairobi or Mombasa County, as well as holding companies that are regulated by the Capital Markets Act. So this is a desired action because interest expense is the major expense for these institutions, and therefore allowing it will allow them to keep trading and not knock them out of business. We also have changes around digital service tax, where non-resident companies that have permanent establishments in Kenya will be exempt from digital service tax. And the argument around this is that these institutions are already subject to income tax. Therefore, is going to remove any instances of double taxation of these institutions. We also have deduction of donations. Initially, donations were not an allowed expense, especially if they were not in cash, and they were not to organizations approved by the Cabinet Secretary. However, this has changed to include donations of any form, as long as they are given to institutions that are exempt from tax, as per the paragraph 10 of the first schedule of the Income Tax Act. And it has also been expanded to cover donations of projects that are approved by the Cabinet Secretary. And therefore, this will allow institutions, or rather individuals, to keep donating for charitable causes and assist the less privileged members of the society. We have changes around the investment deductions, where investment deductions from bulk storage and handling facilities that were supporting the standard gauge railway exceeding 5 billion had an accelerated investment deduction of 150%. So, however, this was allowed up to 31st of December 2022, but this has been extended to a period of an extra 12 months, and therefore it will be up to 31st of December 2023. There has also been reintroduction of investment deduction of 150% if the cumulative investment of the preceding 4 years exceeds 2 billion shillings outside Nairobi and Mombasa County. As per the Finance Act of 2021, this had been reduced to 100%, but now it has been reinstated to 150%. And the goal for this is to actually decongest Nairobi and Mombasa and reduce regional disparities. There has also been an expansion of the scope of transfer pricing around country by country reporting for multinationals. There was the introduction of additional reporting for multinationals in the Finance Act of 2021, where multinationals who had an ultimate parent company in Kenya were required to report to the commissioner of the nature of their financial transactions of the ultimate companies and related entities of different jurisdictions. And this has now been expanded, where they have to notify the commissioner if they are the ultimate parent company, or if they are the surrogate company, and they are tax residents. So they'll also be required to file the master file and local file within 6 months after the year end. And this is going to affect businesses whose turnover exceeds, is going to affect multinationals whose turnover exceeds 95 billion shillings. And so the implication for this is that it's going to increase the compliance cost for most multinationals. And therefore, we are likely to see a lot of instances of transfer pricing audits, where KRA will use the additional information to do adjustments. And we can see this has aligned with the OECD guidelines around the revenue threshold required for multinationals to report the nature of their transactions, where as per the OECD guidelines, there's a requirement that if you have transactions exceeding 750 million euros, then you have to report the nature of your transactions. We also have changes around financial derivatives accruing from non-residents, where non-residents will now be required to do withholding tax of 15%, where a financial derivative is an instrument that is expected to be settled at a future date by the non-resident. So the goal of this is to create equality, since financial derivatives of residents are taxable already. Sorry for that. So we also have changes around the capital gains tax, where there has been an increase from 5% to 15%, beginning 1st of January 2023. And the goal of this is to align with the regional capital gains tax rates. We also have changes that are around the pay as you earn, where we have a removal of the ambiguity of the term permanent home, where a permanent home will now mean where the individual resides or where their economic interests lies closest. And this will allow the commissioner to determine if the person is actually a resident and should be taxed as a resident or not. We also have changes around the earnings from employee share options. Initially, employee share options were computed based on the difference between the offer price and the market price from the date the option is granted by the employer. However, this has changed to be the offer price from the date the option is granted by the employer, and the market price from the time the employee exercises the option. This is very likely to increase the tax on employee share options. However, there is also a controversy of this because as per the Income Tax Act, the term market value still means the value at the grant date, and therefore it's likely to contradict with this amendment. We also have changes around payee penalties, where initially they were guided by Section 37(3) of the Income Tax Act, and they could only allow the commissioner to remit penalties in whole or in part, mostly where the commissioner could only charge a single employer who has failed to deduct employee taxes up to a maximum of 500,000. However, this has been deleted and is now guided by the Tax Procedures Act. We also have changes around the insurance relief, Initially, the insurance relief could cover husbands who had life insurance or life coverage of their wives and their children, but this has now been removed to include both genders, and it's likely to eliminate gender biasness and create equality. We have changes around value-added tax. And I think the first thing we're going to handle is the emerging trends around value-added tax. We currently have an ongoing provision where VAT registered taxpayers are required to comply with the VAT electronic tax invoice regulations beginning from 1st of August 2022. And this is based on the provisions of the legal notice of 2020. We were supposed to comply within 12 months. However, this was extended up to 1st of August 2022. I will allow my colleague Fred to run a poll. Fred. Yes, thank you very much, Fred. I think the first discussion on this poll is around, the first poll is, did you know that all the VAT registered taxpayers are required to comply with the VAT electronic tax invoice by 1st of August? And Fred, could you kindly share the results? Yes, I think most of you, 45% of you have complied with this. And I still see a few people are not aware. Others are yet to comply. Yes, so as discussed earlier, what we mean by VAT electronic tax invoice, it's a new system that is able to share VAT data with KRA on real time. And therefore, it's required that VAT registered taxpayers as of 1st of August should get the upgraded electronic tax invoice. If you have any question around this, please share it on our chat or the Q&A section. We also had another discussion. Will the compliance with the new VAT electronic tax invoice regulations result into increased VAT? Most of you are of the opinion that yes, it's going to increase VAT collection. Others are of the opinion that it's not going to increase the VAT collection. And I think we're going to discuss this the question and answer session. where we'll get to understand why most of you feel that it's going to increase VAT collection. However, the goal of this electronic VAT tax invoice is to reduce the number of inconsistencies. I think in the recent past, we've seen a lot of issues or inconsistencies raised by KRA because of probably the difference in invoice numbers, or someone did not declare a sale. And I hope that this is going to settle that issue. Thank you very much, Fred. We are going to proceed on the changes around value-added tax, where the first change is on the definition of the digital marketplace. Initially, the digital marketplace included the words, included the sale or provision of services of goods or provision of goods and services or other property, but this has been deleted to include the sale of goods or services over the internet, which really prevents ambiguity and allows ease of interpretation of these words. We also have changes around exemption of suppliers on the digital marketplace from the reverse VAT, where reverse VAT means VAT on imported services. So this has been removed. However, I think it's really going to affect the way we are doing business, because I don't know how the government intends to get information on this, because we do not expect non-residents to report on VAT data. And if residents are also exempted by this, from reverse VAT, then I think I don't know how we're going to be reporting on this. However, on the positive side, it's going to be a relief for most importers, because it will reduce their compliance cost and the stress around reporting reverse VAT. We also have changes where individuals who are trading in the digital market are required to register for VAT, whether or not they have hit the 5 million threshold. And it's going to increase the cost of compliance for traders on the digital marketplace. You have changes on claiming of input VAT, particularly for participants of open tender systems dealing in petroleum products, where they'll be required to provide to the commissioner additional information on input tax. They'll be required to share information on the custom entry that will include the personal identification number of the winner of the tender, the name of other oil marketing companies participating in the tender. However, this is not going to affect people who had input tax before 1st of July 2022, and they'll still be able to claim their input tax within 12 months. However, after 1st July, this has been changed to be within 6 months. There is also changes around VAT refunds for manufacturers who are offering supplies to official aided projects. Initially, they could only offset this input VAT with output. However, right now they can apply for a refund within 12 months. And it's going to reduce the cash flow issues that we've been seeing with most VAT registered taxpayers. There's also the harmonization of importation penalties with the Tax Procedures Act. Initially, there was a conflict of whether penalties relating to imports should be charged based on the custom laws, that is the ECMA, or as per the VAT Act. However, this has been amended by including a provision that this will be based on the Tax Procedures Act, and therefore it will be in compliance with the Induplam rule, where the interest and penalties cannot exceed the principal tax payable. We also have changes around refund of VAT paid in error. Initially, as per the provisions of the VAT Act, taxpayers could claim VAT paid in error within 12 months. However, this has been changed to be up to 6 months, and will be guided mostly by the Tax Procedures Act. So therefore, taxpayers need to be alive and vigilant about VAT paid in error to claim their refunds within 6 months. We have changes around reclassification of supplies. Initially, there were some supplies that were exempt and are now taxable. Others were zero rated and are now taxable. Others were taxable and are now zero rated. So to begin with, we have supplies that were exempt and are now taxable. And the first supply includes goods and services for the exclusive use of construction and equipping specialized hospitals with a minimum bed capacity of 50. Initially, this was exempt, but is now taxable at the rate of 16%. However, hospitals that were allowed by the Cabinet Secretary before 1st of July in respect to taxable services will be allowed to keep trading as exempt until the full supply is made. There is also an amendment where some items were exempt and are now zero rated, and they include fertilizers of Chapter 31 and exportation of taxable services. I think this is going to affect most of our businesses since we trade in taxable services, and this is just limited to business outsourcing services. So most of the taxable services, exportation of taxable services, will now be taxable. We also have suppliers that were initially taxable and are now exempt, including plant and machinery of Chapter 84 and 85, imported by manufacturers of pharmaceutical products. We have medical oxygen supplied by registered hospitals. We have urine bags and adult diapers, locally manufactured passenger vehicles, input and raw materials of passenger vehicles, sustainable fuel pellets for household and commercial use, bioethanol vapor, mostly used in cooking appliances and plate warmers. And we have inputs and raw materials upon approval by the Cabinet Secretary for National Treasury that are engaged in special operating framework arrangements with the government and incorporated for purposes of undertaking manufacture of human vaccine. We also have capital goods that are used to promote investment in the manufacturing sector and above 2 billion shillings. So the implication of this is that for exemption of locally manufactured passenger vehicles, I think it's going to promote locally produced goods. However, I don't know if this is going to work because it's not going to reduce the prices of these products since taxpayers cannot claim input VAT on it. And suppliers who are trading in wholly exempt products, they could actually consider the registration of VAT since it's not necessary for them anymore. We also have changes around products that were initially taxed at 16% and now they have a different rate, including liquefied petroleum gas, which was initially at 16% and is now at 8%. We also have raw materials that are imported by manufacturers for manufacture of fertilizer. It was initially at 16%, but it's now at 0%. However, this will be based on the approval of the Cabinet Secretary of Agriculture. And the goal for reducing these rates, particularly for liquefied petroleum, is to allow environmental conservation and to allow people to keep using the environmental friendly sources of energy. I'm going to allow my colleague CPA Nimrod to proceed from here.
Thank you, Tabitha, for the presentation, and you'll allow me to share my screen. Maybe you can remove your
Yes.
presentation. Okay. Yeah, thank you. And I believe at least you've picked something which is relevant to your businesses, so that we make sure you always remain compliant with the tax regulations. The remaining changes mainly covers the Tax Procedures Act and also the excise duties and the miscellaneous levies. And we've picked some of the critical changes which we believe relevant to your businesses. And one of them is the requirement mainly which affects registered trusts. Previously, under change of particulars, the Act has omitted any change relating to the registered trust. And what they have now clarified is even if the trust is dormant, you'll need to update those changes and report the change to the commissioner. And I believe this was mainly informed by the fact that most registered trusts, they are not doing any businesses. Most of them could be holding parcels of land, and they are doing nothing during the year. So the Act has now amended Section 9 of the TPA to require trusts, whether carrying business or not, to notify the commissioner of any change within 30 days. Penalties this is also on changes to the Tax Procedures Act, especially Section 40 of the TPA Act, which has now increased the scope of the commissioner to recover taxes. Previously, the commissioner was only interested in land and building. That was the scope of Section 40 in the previous TPA. He has now expanded the scope of the definition of property to mean land, building, aircraft, ship, motor vehicle, or any other property which the commissioner may deem sufficient to serve as a security for unpaid taxes. So members, be on the look. The commissioner can come for any other assets apart from land and building, as was the case before. Can come for your motor vehicles or any other property. I'm not sure of what he means by any other property. Can he come for your animals? Possibly yes. So for Section 40, the scope has been increased so that the commissioner has various mechanisms of recovering unpaid taxes. Next is Section 47 of the TPA Act, which was also amended. This is mainly on refund of overpaid taxes. And the only change under this section, Section 47, is taxpayers, you now have a leeway to apply to the commissioner for a refund of overpaid taxes. And there are two options. Either you will seek to be refunded, or you can utilize the overpaid taxes to settle future tax liabilities. And I think what I need to emphasize here is on the word future tax liabilities. The commissioner, they rarely apply any overpaid taxes to settle prior year taxes. Yeah, is concerned about the future tax liabilities. And I think this is a good thing, especially for most of the taxpayers who have significant overpayment of installment taxes. You can apply so that the commissioner can utilize the overpaid installment taxes to offset against future tax installment. The other positive thing is KRA has to respond within a period of 90 days. And I think this is also important, especially for people who want to utilize overpaid taxes to pay installment taxes. The other change is on refund on tax paid in error. The Act introduced this provision on the refund of taxes paid in error. Previously, it was only under the VAT Act. So what this means is taxpayers can apply for tax paid in error, but of course, it will follow the normal process where the commissioner has to assess whether the payment, the claim is correct or not. And I think this is basically a positive thing, especially for people, especially for people registered for VAT, where if a service or a commodity is you had erroneously applied the VAT rates at 16%, and you found out later that the product or the service is zero rated or exempt, you can use this section to claim for the refund. Those were the key changes, mainly under the PPA Act. The other changes which you will see in our detailed tax watch are mainly on alignment or also interpretation of certain provisions which may not be relevant to most of us. I move straight to changes affecting excise duties. This is one of the area where the commissioner is moving towards increasing number of items which are subject to excise duties. The change introduced this year is on the annual inflation, which has now given the commissioner, course subject to approval by the cabinet secretary, to exempt specified products from inflation adjustments after considering the prevailing economic circumstances in respect of such product. I think this is mainly to give the commissioner that powers to select which products he can exempt from the annual inflation. The other one is this could be this is housekeeping in terms of harmonization of interest and penalties on imported goods, because under the East Africa Community Customs and Management Act, they're trying to align the tax laws to the Tax Procedures Act, where the Act has now clarified that PPA Act also applies when you are interpreting or when they are administering the East African Customs and Management Act. And key to note is mainly the issues of imposition of interest, where the East African Community Customs Management Act allowed interest expenses to be even more than the principal taxes. So this has been clarified so that the interest charged is not more than the principal taxes. There were several items which the rates were changed, especially this is the first and second schedule of the Act. And we've listed some of the changes proposed or effected. And we recommend that you go through so that you identify which one will affect your businesses. Of course, this is one of the revenue lines for the commissioner. But every year, they increase the number of products subject to excise, or they can also increase the rate of taxes. But key to note, under this section, especially on, you can see there is introduction of duties, especially on imported potatoes, which previously it was nil to 25%. I think you all remember the public discussion, I don't know that it was last year, on where some outlets ran out of potatoes. Yeah, mainly because most of their potatoes are being imported from other countries. So I think the commissioner, to protect the local markets, introduced imposed 25% excise duty. The other one, which is common to most of us, is imported ready-to-use SIM cards, where this was not there previously, and also excise duty on fees charged by digital lenders. The rate was nil, now it's 20%, and you'll be seeing most of the digital lenders increasing either their interest rate. The other one is on excise duty on importation of cellular phones. Most of us in this sector, and you'll be seeing an increase in the cost of acquiring phones, where the rates of 10% was introduced. We will share the detailed presentation so that you can familiarize yourself with the new items introduced in the first and second schedule, and also the change of rate. The exemption of excise duty. Sorry for this. Amendment of on the second schedule. This is also a continuation of some of the changes which they have brought in new items. Key to note is the locally manufactured passenger motor vehicles, which is defined as motor vehicles for transportation of passengers, which is manufactured in Kenya, and whose total value comprises at least 30% of parts designed and manufactured in Kenya by the original equipment manufacturer operating in Kenya. Of course, the exemption is subject to prior approval by the commissioner. And if you look at the detailed act, you will see several conditions to be met, especially on key definition. What is considered as parts designed and manufactured in Kenya. So please, when you receive our detailed tax watch, please go through so that you're informed. On miscellaneous fees and levies act, the key changes were mainly on export duties, where introduction of an export levy of $175 US dollars 175 ton on iron ores and concentrates, including roasted iron pyrites. And this is mainly to protect the steel industry. I know all of us, you remember this year, the fight or the huge increase in terms of the cost of construction, especially on iron. And I believe the introduction of this levy is mainly to protect some of the sectors or industries affected by the issues of exportation of metal scraps. The other exemptions, this is mainly on the health sector, the pharmaceuticals, from the IDF and the RDM, which is the Railways Development Levies. And most of these exemptions mainly targets government projects. Yeah, and if you read the wording, it's mainly subject to Cabinet Secretary approval. That's the Cabinet Secretary for the National Treasury, as well as Cabinet Secretary. So these are mainly huge projects where they have mentioned investment value of which is not less than 10 billion Kenya shillings. So these are the key changes which, if you in this situation and you can qualify for this exemption, I think it's good to take up this offer. The other acts, we've only picked one, which is the Unclaimed Financial Assets Act, which is still a new act which was introduced a few years ago. The act did not have any provision for waivers of penalties, fines, and audit fees. And I believe the introduction is a positive thing, especially on organizations who are trying to comply with the provisions of the Unclaimed Financial Assets Act. Capital Markets Act, key change was mainly expansion of the persons who can act as investment advisors. And this is an area where you can consider, and the requirements have been reduced in terms of who can act as an investment advisor. And so this means even an individual or a professional can qualify as an investment advisor. So those were the key changes which were in the Finance Act 2022. I think we can now open the Q&A session where we can have an interactive discussion on areas where you need further clarification on the changes in this Finance Act. And I'll allow Fred to take us through this session. Thank you.
Thank you, Nimrod. Thank you very much, Tabitha, as well. You have indeed taken us through that section in an elaborate manner. So I can see 3 individuals with their hands raised. So I'll give you a chance and you unmute your button, then you speak. So I'll start with Duncan Kibele Kenya, then I'll come to Lucy Chepkwony and then Hilda Maina. So Duncan, I'm sure you're able to unmute. Duncan, are you able to unmute? And so try if Lucy Chepkwony can. So Duncan, you can talk, yes. So just ask your question.
I was just asking about the meaning of TPA.
Okay.
Yeah,
Alright,
because
you said TPA.
yes, TPA.
Okay. So Hilda, your question? So the team will be noting that down, then certainly they'll come back to you. So Hilda, you can also ask your question. Hilda, can you hear me? I can see Hilda seems to have forgotten that she had asked a question. All right, maybe you can have that. Then I'll read a few questions that have already been posted here at the Q&A section. In fact, Hilda was asking that, is it true that the new ETR machine should not be categorized as an asset? Yeah. I think that was a yes or no question. So maybe you can respond to that, to those.
Okay. Duncan, yeah, so TPA is, sorry, I think we should have included in our slides, it's the Tax Procedures Act. Yeah, Tax Procedures Act. Then the other one was
on ETR machine,
yeah.
That is it true that the new ETR machine should not be categorized as an asset?
Yeah, I think should be. I think it can be categorized as asset. I don't have any problem with classification as an asset.
Okay. Lavrin by Kiata is asking, what are the rates for capital allowance for motor vehicles, plant, and machinery?
Okay. Yeah, the rates. There's a whole schedule, second schedule of the Income Tax Act. So she needs for which, is it motor vehicles plan or both?
Both.
For motor vehicles plan and machinery. Okay. I think we can share the entire summary of the second schedule. Because when you talk of motor vehicles, what kind of motor vehicles? Because plant and machinery, I believe you can get in touch with us so that we can give them a personalized advice on because plant and machinery, what are you doing? Are you doing manufacturing? are you doing manufacturing or normal plant and machinery? So maybe we can advise him or her to get in touch with us so that we can
Alright.
give a comprehensive advice.
All right, so Hilda, you can reach out to us through the links of the contacts provided for our case-by-case scenario that has specific answers related to that. I can see a question here by a question on exportation of transport. Is it exportation of transport services? When we sell goods outside the country and we have to pay for the transport costs, is this also taxable at 16%? Yeah, so that's a question there.
Can you activate the voice so that they can, sometimes it's good for them to explain so that we don't give the wrong opinion.
I think this is then for every one of us. If you have a question, this is the point to raise your hand, and then we give you a chance. You unmute your microphone, and then you are given a chance to speak. I can see Wycliffe Mongare has raised his hand. Let me just give him a chance as well. Wycliffe, can you unmute? If that's not possible from your end, you can probably type your question at the Q&A or the chat section.
Can you hear me?
Yes, we can hear you now. Thank you.
Hi, everyone. Now, my
Hi.
question is regarding the new ETR machine. Do you also have to have the new ETR machine if your services are exempted or zero rated? Or you have to be you have to be registered for VAT. That means you have to be 16% or 8% before you have the machine. Thank you. Did you hear my question?
Yeah. Sorry, you're saying, please maybe you can come again.
Yeah, I was asking, for example, if your services are exempted from VAT, do you still need to comply with having the new ETR machine?
Oh, maybe I can ask, are you registered for VAT?
Yeah, we're registered for VAT, but exempt services.
Or exempt services?
Yeah.
When you're dealing with exempt services, I don't know what to inform the registration, because you're not supposed to register for VAT.
So what happened is the company had initially registered for VAT, but then they got some accounting services advice that they were actually not supposed to have registered for VAT. So they just retained the VAT, but they changed the services to exempt. So they no longer file VAT, they just declare, but don't file or pay. They file, but they don't pay.
Oh, okay. So I think maybe going forward, you may need to consider to deregister. But in the meantime, because the new provision addresses those people who are registered for VAT to acquire the new ETR machine. But of course, if you don't qualify, because if you're in business and if you are services or goods are exempt, normally you're allowed to apply for the registration. So maybe that's my advice on your case. Thank you.
Yeah,
that ETR question, a majority of people are asking about it. And so there's just to say, we will also share with you the notes soon after this, so that you're able to have this on your database for your own reference. So do not worry about the notes. Great. I could see Hilda had raised her hand. I don't know whether she's struggling with me. Hilda, can you hear me?
Yes, now I can. Apologies for that. Initially, I had an audio problem.
Okay, okay.
No, I have 3 questions.
Maybe as you speak, maybe you can just tell us where you're working from, or the name of your company, and then you ask the question.
Oh, apologies for that. My name is Hilda Maina. I'm from a company called Kenya Network Information Center. That is
Network
KENIC.
Information Center, KENIC, okay.
Kenya Network Information Center. So my first question is in regards to the new implemented rules on Teams. And I've seen the presenter has said there's a way or how we can be able to seek an extension in case you have not complied by 31st. So I'll ask for clarification what is required from our end. That is in case, because some of our delays are being caused by the supplier. So probably if the presenter can elaborate how best we can go forward to request for an extension, because it's clear we might not be set up by 31st July. The other question is on the income tax presentation that has just been done in terms of refunds, and I'll seek your guidance on how to go around. Last year, we had started implementing DST, which we paid for some few months. So come end of the year, we realized we had a tax overpayment, which contributed from the installment taxes that were paid, as well as the DST. But when you go to iTax and try to request for a refund, I've noticed that they have not captured the DST element, but they have captured the overpayments from the installments. So again, how as a customer, so how do we go around that? Then still on DST, I've seen the Finance Act 2022. All the changes are going to be implemented 1st July. So that does that mean that come August, we'll be required to pay again the DST for the month of July, or how back can we go? That's all. Thank you.
Emma, did you get your questions? Yeah.
I'll allow Tabitha to respond.
Okay.
Okay. Thank you very much, Hilda, for your question. So the first question was on the ETR. So initially, we were allowed to apply for an extension of time, but I think we are way past the deadline, because we were supposed to apply for an extension of time 30 days before the implementation. That is, we were supposed to have an approval before 30th of June. And what I meant by an extension, if you have tried to procure that machine and it's the delay on the side of the supplier, then the supplier has to send a notification to KRA saying we are out of stock for particular machine, and you've tried to find from other suppliers, but you can't get it. So it's the job of the supplier actually to say we are out of stock, and they have to show that you are actually on the queue. You have to have evidence that you are on the queue waiting for that machine. I think the next question was around the DST refunds. I think this one we'll have to review and just try to understand the case before we can respond. Yeah, and about the application of these changes. So the changes are applicable from 1st of July 2022, but unless it's stated otherwise, I've just seen there are only 3 changes that are effective 1st of January 2023. So for the DST, I think you'll have to pay from July, from 1st of July 2022. I hope your question is answered, Hilda.
Yes, CPA Tabitha, I think you have answered it sufficiently, and thank you for that.
Okay, thank you very much, Hilda.
Lucy Chepkwony, you've raised your hand. You have a question. Just unmute your button, and then you're able to raise your question. All right, maybe I can do 1 or 2 more questions, then we close it there. So I'll just go to the Q&A. I think there's an anonymous, so somebody was asking, do we charge tax for a non-resident company or individual which carries out its activities in Kenya and is doing importation of goods through an agent company resident in Kenya? I don't know, Tabitha, you can be able to respond to that. And then maybe we also respond to Agnes here is asking, there is application for tax refund done online on the iTax platform. And then the last question is, do we need a new ETR? I think that one was already answered. So maybe answer those two questions, then we can able to close it there.
Thank you, Fred. So for the first question, I think it's about the resident company carrying out transactions in Kenya. For them to be taxable, then we have to establish if they are the nature of their establishment, if they have a permanent establishment in Kenya, and if they're trading in Kenya, then it's a requirement of the law for them to pay taxes in Kenya. I don't know what the next question was, Fred.
The question of, is the application for tax refund done online on the iTax platform?
Yes, application of refund, yes, is done online on the iTax platform. There's a section for refunds where you can fill in the claim details, and actually it's automatic. You can see the number of refunds you have.
Okay.
Yes.
Maybe I think there's a gentleman here who is from a law or a legal profession, is asking whether the law firms also need to apply for ETRs by 31st July, which is the next few days. Is that the true position, Tabitha?
Yes, thank you for the question, Fred. So for the ETR, as long as you're registered for VAT or you are likely to hit the 5 billion threshold, then it's advisable for you to get the new ETR. And if you're trading in taxable services and you've hit the 5 million, then it's a requirement of the law for you to have the new ETR.
Thank you. And Lavrin by Kiata. So as I can see, you're requesting for a transfer pricing webinar. Thank you for that lead. We'll organize that and certainly get back to you when we will be doing that within the year. Before the close of the year, we can arrange for a transfer pricing webinar and certainly alert you now that we have your contact. Again, I just want to say thank you for everyone for registering and creating time to join us today. Again, thank you again for Nimrod and Tabitha for elaborating on the various tax aspects and the changes in the Finance Act for 2022. I don't know whether you have one parting shot or two, then we close it there. Nimrod?
Yeah, thank you, Fred, and thank you to all of us, the participants, for joining us this morning to look at the Finance Act 2022. And I think my closing remarks is mainly on the tax refunds. Kindly bear in mind the timelines which are available. You should apply within 5 years for the normal, for corporate, for other taxes, but 6 months for VAT. So I think that's a technicality which we all need to have in mind so that we are not time bound. So thank you so much, and we'll be sharing the notes, our emails, lines, always available or open in case of any tax issue. We'll be happy to assist. Thank you.
All right, thank you very much, everyone. You have a very wonderful day.